going to be going through a lot of stuff in a short amount of time. So be sure to be taking notes, paying attention to what we're doing. There's going to be a lot of information here. Now, today's topic and what we're going to be talking about today is what we just really call our roadmap to minimizing taxes. And this is really kind of what we say is specific to business owners. So before I get started, I just want to introduce a little bit about myself if you don't know me already. My name is Mike Jeselchek. I'm a CPA, host of the Small Business Tax Savings Podcast. I'm also a partner over at Insight, which is a partner accounting firm that we work with. And I'm also the creator of the Tax Minimization Program. And just a little bit about me, been an entrepreneur since the age of 14, been in all different types of businesses. Didn't actually get into accounting and tax until a little bit later, but started in an online marketing industry. Have been partners in businesses, have owned my own businesses, have had successful exits, have had some massive failures along those businesses. And really what I've started this podcast from and what we try to teach people is just take some of those lessons I've learned along this journey, all the great things and the bad things and everything that in between there, and utilize the things that I've learned from that to help out other business owners that are going through those same exact ebbs and flows. So that's really kind of what we're doing in the podcast. It's what we're doing in our accounting firm. It's just to hopefully help people along this journey of being an entrepreneur, because I know as much as you do, that this idea of being an entrepreneur is not an easy task. Now, what my mission is now, where most of my time is focused on, is that my goal is that I want every business owner to know the strategies that are available to them to pay the least amount in taxes as legally possible each and every year. As I was going through this journey of being an entrepreneur, one of the reasons I got into accounting is because I kept getting stuck or kept getting hit with these big tax bills and not knowing or not having a resource to go to find out what can be done out there. So I started to do my own research. And I always kind of give the story of, before I got into tax, I worked with an accountant that I would bounce ideas off of, get some recommendations from. And every time I'd ask a question, I'd get this answer of saying, well, it depends. Can I hire my kids in my business? It depends. And I kept getting that answer from accountant after accountant. And finally, I got to the point, I understand it depends. But my goal is that I want to say, okay, for 95% of the cases out there, for the majority of the people that are on this webinar today, what does make sense to them? What is a valuable strategy and how do we implement that? And so really my mission with everything we're doing now is help people pay the least amount of taxes legally possible. And we're doing that by making them informed of the tax strategies that are available to them. Now, of course, there's going to be some situations you're going to want to bounce it off your accountant, but we want to at least give the core, the basics of the core understanding to everyone out there, and then just customize that little bit of piece. So I hope that's my goal, is that idea of it depends kind of goes away. Now, just a little bit of disclaimer before we get started. Everyone's situation is different, and this is kind of that it depends statement, but I do want to say that this is just something we say up front is what we discussed today is really just a hypothetical scenario of a family that we are going to be going through in this roadmap. It's based off of real life situations, but the client names and things like that have been redacted. The tax savings that we talk about today throughout the webinar are based on a marginal tax rate, and the tax savings are rough estimates. We didn't want to go into too much detail or go too deep. We just want to get an idea out there to kind of tell you or show you what type of savings are available. And everything we talk about today needs to be set up and fully documented. These strategies have to be implemented correctly. So we're going to talk about hiring our kids. We're going to be talking about the S corporation. These things, if you're doing them, need to be set up correctly and make sure that we're dotting our I's and crossing our T's. And of course, discuss with your situation with your accountant about what we're going to be talking about, just so that they are made aware of kind of your situation to see if there is any kind of anomalies. All right. So let's kind of get started. Now we got that out of the way. Again, today we're going to be talking about that roadmap to minimizing taxes. What does that look like? What does that kind of journey to tax minimization look like? And we're going to be talking about that complete journey at the end as well. So first off, I just kind of want to introduce you to the family that we're going to be talking about today. This is a scenario that we're putting together to help show you, okay, this is the type of income this person's making. These are the type of savings that are available, and I'll help you hopefully understand this is available to you, whatever stage you might be in your business. So when we go through our scenario today, we're going to be talking about a family of four. It's a husband and wife and two children. Children's ages are 10 and 14. They have a business that it has income or is profiting $200,000. And it's basically a consulting business. It's a consulting business for small businesses, and there's no employees outside of the owners that are working into it. And the current tax scenario is that they're paying federal income tax of $15,800, and they're paying self-employment taxes of $23,700. And so their total taxes in their current state, right, in that $200,000 range with the scenarios that we've talked about, they're paying just under $40,000 in federal taxes. Now, we'll say everything we talk about today is on the federal level. We're not going to get into the state level as far as what tax savings might be available there. We're just looking at that federal level, that high level of tax savings that we're going to. So we talked to this family and said, okay, you're ripe for tax saving opportunities. And we talked to them about what they're currently doing. And they started listening to our small business tax savings podcast. They joined our tax minimization program. And that was really the start of their journey, their start of their tax savings journey. And so the first place we stopped with them is this idea of tax planning versus tax paying. And this is a concept that is just kind of a mind shift. Most people, when they hear the word tax, they think of seeing their accountant once a year in February, March, or April, give them their documents, and then they don't see their accountant again until next year. And while that's important and that's required by law, that is the act or the practice of tax preparation. You're preparing taxes and filing taxes. And again, that's important, required by law. But what I feel is even more important is what should come way before we're preparing and filing taxes. And that's this idea of tax planning. What are we doing? What strategies are we implementing? What choices are we making throughout the year to ensure that we're paying the least amount in taxes legally possible when we do that filing? And when it comes to taxes and tax planning, the cutoff really is December 31st. Once that year is over, there's not a ton of strategies that are available. Now, sure, there's some strategies that we can implement, but once 12/31 hits, there's not that many strategies that are still available for us to utilize. And so if we're only seeing our accountant in February, March, or April, the year's already over. Our opportunity for tax planning, our opportunity for implementing strategies could be closed. And so that's the mind shift that I want people to think about when we're on this webinar today is how can I start thinking about today? What can I do now? What can I do here today to make sure that I'm paying the least amount in taxes legally possible so that when I see my account in February, March, or April, I already know I'm paying that tax bill is as low as I possibly could have gotten it for this year. So that's kind of the number one mistake that we see small business owners make is just failing to plan, failing to think about tax planning. And a lot of times that comes from people thinking that tax planning, tax strategies, that's just for the rich, or I'm not big enough for them, or maybe I'm too big for tax planning, or it's too complicated, it costs too much money. And those are the myths that I hope to squash today and say, okay, that's not the case. Whether you're making $1,000 a year in a business or you're making $1 million or more in a year in a business, there's tax strategies available to you. And often they're the same exact tax strategies at that drastic of an income level. So that's kind of this idea of tax planning versus tax paying. Now, the first thing I want to talk about, and this is going to kind of lead into much of the things that we're going to be talking about, but this idea of pre-tax versus after-tax dollars. And we always say you lose every time you spend after-tax dollars that could have been pre-tax dollars. So let's put this into a little bit more context. After-tax dollars is money that you spend after it's been taxed. And pre-tax dollars is money you spend prior to it being taxed. And so let's use kind of an example to help us understand what this means. Let's think about COVID. When COVID hit, if you were a W-2 employee, you worked for somebody else, you were sent home and you had to work from home, you had to buy a desk, you had to buy maybe an extra monitor, you're now having the heat on during the day, or you're utilizing the home internet, or maybe you had to go buy internet, and you're utilizing all these things, and you're a W-2 employee. But because you're a W-2 employee, you get no tax benefit from that. You get no tax deduction for that spending, that desk you bought, that monitor you might have bought, that extra electricity, that cable or internet bill that you're paying now that's might be a little bit higher. All of that is coming with after tax dollars. So when you're an employee, you get your gross wages, that's whatever your salary is or your hourly rate. You get all these taxes taken out, and then you get your take home pay. And all that spending you do with your take-home money is called after-tax dollars. Your money has already been taxed. Now, when we look at a business owner, with a business, we have sales or revenue, and then we have all these expenses that go into it. And then whatever's left over, that's what we get taxed on. So that desk that we bought, that monitor that we bought, a portion of our home office, a portion of our internet bill, all of that, now, if we're a business owner, that becomes a deductible business expense. And we're choosing pre-tax dollars to take that when we spend money on those items. So when we talk about pre-tax versus after-tax dollars, we want to think about how can we find a reason, or how can we find a business purpose to move typical after-tax spending into pre-tax spending. And so we talk a lot about this idea of maximizing deductions. And when we talk about maximizing deductions, so many people immediately go to, oh, I'm going to have to go buy a truck that I don't need, or I'm going to have to go pay or do this that I don't need just to get a tax deduction. And we're saying, no, 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 no. We would never advise someone to buy something they don't need for a tax deduction. It doesn't make sense. But what we would advise someone to do is do spending that they're going to do no matter what. Take that spending, find a business purpose to it, and move it from typical after-tax dollars into pre-tax dollars. And so a lot of what we're going to be talking about today is how do we do that? And so I wanted to kind of preface this entire webinar with this idea of pre-tax versus after-tax dollars. Again, after-tax dollars is money you spend after it's been taxed. You get no deduction for any of that spending. Pre-tax dollars is spending that was done prior to it being taxed. And so how can we move after-tax spending into pre-tax spending? All right, so let's dive into the strategies. And again, if you have questions as we go along, put them in the chat, put them in the Q&A. We're going to be going through a lot of stuff today. We're going to go relatively quickly because I want to make sure that we can get it all in. We're going to be talking about a lot of good tax saving strategies. The first one that we want to talk about is an S corporation. And oftentimes we call this our core strategy. So when we talk about tax strategies, we have core strategies and advanced tax strategies. The S Corp is like our core of our cores. And basically, it's a tax strategy to help minimize self-employment taxes once your business grows to a point where it makes sense. And so typically we say once your business grows to a profit of $50,000 or more, we recommend setting up an S corporation. So let me go into the reasoning behind an S corporation. If you're a sole proprietorship or a single member LLC, 100% of your income gets hit with self-employment taxes. So if you make $80,000 a year, or in our client's case, $200,000 a year, you're going to get hit with self-employment tax on 100% of that income. With an S Corp is just a tax election. So you still remain an LLC, you still remain an LLC. We're just electing for it to be taxed as an S corporation. And as part of that election, we now have to take reasonable salary. We have to take W-2 payroll to ourselves as an owner of that company. But as moving to an S corporation, we basically split our income into two pieces. We have a salary, which we're required to take a reasonable salary, and then we have owner draws or owner distributions. So we take that income that we have and we split into two. Now that salary, that reasonable salary we take, is still subject to self-employment taxes. Now they don't call it that, but essentially it's the same thing. So we still get hit with self-employment tax on a reasonable salary, but the owner's draw and the distribution that we take, we eliminate self-employment taxes on. So instead of paying self-employment taxes on 100% of our income, now we're only paying self-employment taxes on a portion of our income that we take as a reasonable salary. So in this family scenario, they had $200,000 in profit from their business. They were just operating as a single member LLC. And we said, let's get you into an S corporation. Let's do that S corp election. And we determined that a reasonable salary for them was $80,000. So you take that $200,000 in profit, they're going to take a reasonable salary of $80,000. The remaining amount, that $120,000 that's remaining, they avoid self-employment taxes on. They still pay self-employment tax on the $80,000 that they took as a reasonable salary, but they avoid self-employment taxes on everything over and above that reasonable salary up until their profit. So by doing an S Corp election, we were able to save them just under $11,000 in taxes, $11,000 in self-employment taxes. Now, there are some downfalls to an S corporation. The first one being is you have to run payroll. You have to run W-2 payroll to yourself. And we always recommend using a software. We use a software called Gusto. but there's some costs in running payroll. Now, if you already have employees, there's no additional cost or very minimal cost to just add yourself as an employee. So that's number one downfall to an S corporation. The number two downfall to an S corporation is that you have to file a separate business tax return. So everything's still going to flow through to you personally, but you have to file a separate business tax return, which obviously has some additional administrative or prep fees involved with that. So those two downfalls are why we typically say, wait till you hit about $50,000 or more in profit to go to that S Corp election. All right. The next piece we want to talk about is something called an accountable plan. And basically an accountable plan is just a fancy word for reimbursement. It's a way to reimburse yourself from the business for items that you paid for personally, or maybe items that were business and personal mix. Now, we're always going to say if you have an item that is 100% business use, just run it through the business bank account, run it through the business credit card account. The accountable plan is only going to be for those items that are mixed use, or you accidentally paid for something on the business or something for the business using a personal card. So one thing that we talk about with an accountable plan is this idea of a home office. This company or this family was operating out of their home office. Their office that they were working out of was 180 square feet, and their total home was 2,000 square feet. And across all of their, mortgage interest, property taxes, home insurance, utilities, all those types of items, they had just under $20,000 in total annual expenses. So what we did, we were able to take a home office, and we did this via an accountable plan. We basically had the business reimburse the owner for the business use of their home office. That's a business deduction and not taxable to the person receiving it. So by utilizing an accountable plan for the home office, we were able to take 9% of that total expenses of $20,000, and that expense created tax savings of just under $400 for this family. The next thing is we took this accountable plan and did even deeper. So we said, okay, home office, great. That's business and personal mix. But they also had an automobile. They had an automobile that they were using for their business. It was a business and personal mix, but they were using it some for their business. They had a cell phone that had some mix, and then they just had some various other items. So for the automobile, they drove 6,250 miles for business-related purposes. So we took a deduction of 58.5 cents on that. And we utilized the home office to help maximize that deduction. Let me tell you why. So many people are afraid of the home office because someone somewhere down the line told them that's a big red flag. It's not. Be reasonable with it. Don't get greedy. The home office is something that nearly every business owner should be taking advantage of. But the beautiful thing about a home office is not only do we get a tax deduction, we just saw that in the last slide, not only are we saving taxes from that home office, but now we're removing commuting miles when we leave our home. So typically, if you go from your home to an office, that's considered a commute. That is not deductible business mileage. But now our commute turned into our bed to our home office. And now anytime we leave our home office to go to another office, to go to a client, to go pick up something work-related, whatever it might be, now we have deductible business mileage. So by utilizing that home office, not only do we get a deduction for that, but now we also have a lot more deductible business mileage than we have because of using that home office. So we took the home office, or we took the personal use of automobile. That was a tax deduction of $3,600. We had a cell phone use. We said about 80% was for business. That was another $1,400. And then there was some various other items that it amounted to about $1,200. By utilizing all of these things, it provided tax savings of just under $1,400 for them. Some of those other things were travel, park and tolls, meals, things like that. All right, let's talk about meal deductions. And this is a key one. And again, this is this idea of moving after-tax dollars into pre-tax dollars. And what I always like to say is, you're talking business, or you're working with people in business more than you even think. You go out to dinner with a friend, or you go to lunch with a friend. They might be a client. They might be a coworker. They might be a colleague. You might just be discussing your business and asking for advice, or you might be talking about their business and how you might be able to help them. Whatever it is, there is probably more times than not that you're out to dinner or you're taking a meal with a friend, a client, something like that can find a business purpose to it. Let's say you're going out to lunch with a friend, and all you do is talk about your business and their business and how you can help each other and everything like that. Traditionally, you're just going to pay for that lunch out of your personal card, and that's going to be an after-tax spending. But if you can say, yeah, there is a business purpose for this. We're talking about business. They're helping me out. They might be a future client of mine, or we're trying to get them to be a client of mine. Let's just take it as a business expense then. So we talked to this client, and especially in 2022, meals are 100% deductible. Traditionally, they're only 50%. But we talked to this client and said, hey, let's try to deep dive. Let's try to go through some of those things, conversations, and let's find ways to find a business purpose for those meals that you're doing. Biggest thing is we just want to document right on the receipt. Who were you dining with? What were you talking about? What's their relationship into the business? Take a picture of it, put it on file, store it away. You'll never need it again. You might need it again, but it's stored away digitally. You don't need to keep it on file at a physical presence. So that is this meals deduction. And so we talked to them. They were able to pick some out. They were able to find ways to move some of that spending, that maybe meals that they were going to have anyways, to find a business purpose for it. Now they moved from an after-tax spending into pre-tax spending, and that provided them a savings of $400 just from that simple switch, some minor changes with some of the meals that they were looking at it. Again, this is just a mindset shift. We want to start thinking of ways that we can move after-tax spending into pre-tax spending. All right, let's talk travel. The next thing we talked about them, and as we were going through our tax minimization program, is they were talking about traveling. And when, we said, what are you guys planning any vacations? And they said, yeah, actually we are. And we said, well, is there conferences? Is there clients? Is there vendors in those areas that you're maybe looking to vacation? And they said, no, but now that you say that, why don't we try to organize some of our travel around those types of things? And so I would never advise someone to do this all the time, because your wife and your kids might start to be like, come on, why are you doing this? Or your husband might start to say, why every time we go on a family vacation are you doing work? But if there's a way that you can organize business trips around other travel, you're visiting a client, you're attending a conference, there's an opportunity there to get a deduction for it. Now, the IRS, when they look at what is considered a business day during travel, is you have to spend the majority of that day on business. And when they look at a day, they look at it as 8 hours. So if you spend 4 hours and 1 minute on business, that's considered a business day. The IRS doesn't care what you do after that. You go to the beach, you go visit a town, you go explore the city. The IRS doesn't care as long as the majority of that day, 4 hours and 1 minute, was spent on business. That could be going to a conference. That could be talking to a vendor. Now, of course, if you're bringing, in this scenario, we had a husband and a wife and 2 kids. If you're bringing all of them and now you have to get a bigger room or a suite or something like that, you wouldn't be able to take that deduction for all of them necessarily, unless they were involved in the business somehow or involved in those meetings. But you would be able to take whatever that rate would be for just you to go. So let's say, average rate of the hotel is $250, but you upgraded to fit all your family in it. Now it's paying $350. We'll take the $250 deduction as a business deduction. So we talked to this family that we're working with, and they had 3 trips that they were organizing and looking at, and that they were able to classify the majority of the time was spent on business. And that included hotel, airfare, meals, and things like that. And they had an additional $6,000 in expenses from that. Again, they were being reasonable for the scenario that was taking place, who was attending, what were they doing? What were the additional costs with bringing family in? But again, they were being smart. They were being strategic. They were thinking outside of the box and saying, how can we pair some of this travel with business items that are going to help my business? And I have to spend a little time on business, 4 hours in a minute. I have to go through that conference or visit that client, whatever it might be, visit that vendor. But the rest of the time they can spend with their family. So by maximizing travel deductions, they were able to save over $1,300 in taxes. This next strategy, and this is one of my favorites, is the idea of hiring your kids. Now, if you remember in this scenario, our family that we were working with had kids aged 10 and 14. And so we were able to talk to them and say, okay, is there anything your kids can do in your business? Now, a few things before we kind of get into this. The children must be doing actual work in your business at a reasonable rate, and you must have clear documentation with agreements and time logs and things like that. So you can't pay, a child $150 an hour to mow lawn for your business, but you can pay them what a reasonable rate would be for someone their age. Typically, we say once they're 7 or older, that's where it opens up the door. And people have maybe be a little riskier, try less, but 7 or older is what has been supported in case law. And the beautiful thing about this is that you get a business deduction and the child pays no federal income tax in the first $19,000 or $12,950 if it's set up properly. So you get a business deduction, child potentially pays no income taxes on it. Again, let's think about this after tax versus pre-tax spending. If you're like me, you're sending kids to basketball camps, you're sending them to amusement parks, you're paying for all sorts of things with your kids. And traditionally, it's going to be all after-tax spending. But what if there was a way that your kid could work in your business, you could hire them in your business, and instead of paying for those camps, you could pay them a reasonable rate for the work that they're doing, and then they can use those funds to go to those basketball camps, to go to those amusement parks. Again, we're changing traditional after-tax spending, after-tax dollars into pre-tax spending, not to mention all the other benefits that come along with this. And so if you pay them out of a sole proprietorship or a single member LLC, you don't have to withhold Social Security taxes, Medicare taxes, federal unemployment, or any of those items. So you get a business deduction. If they're under the standard deduction, they pay no income taxes on it, which is just over $12,000. And if you're paying them out of the sole proprietorship or a single member LLC, there's no Social Security, Medicare, which is FICA taxes, federal employment that needs to be held. It's just a transfer, basically business deduction. Child pays no income taxes. Now you might be saying, well, Mike, we talked about an S corporation, not a single member LLC. Since this couple or this family that we're working with set up an S corporation, then we have to set up a family management company, which the S corp was contracted to. So the S corp did, or the family management company did work for the S corp. The family management company was a single member LLC, and then they paid their children out of there to avoid that Social Security, Medicare, federal employment, and all those items. So we looked at their family and we said, okay, what can the 10-year-old do? We found some things that they could do in the business, paid that 10-year-old $5,200, and the 14-year-old, we paid $12,000. Now, so many people come to me and say, Mike, what could my child possibly do in my business? I'm a law firm, or, whatever it might be. What could my 8-year-old do in a law firm? They're not an attorney. And I say, well, let's get creative here. We're talking about tax savings. We're talking about tax strategies in many other ways. So what can we do? What can we find them to do? Could they be shredding papers? Could they be stuffing envelopes for a mailer that you're doing? Could they be doing social media posts to you? And a lot of times that same person will say to me, well, I don't do social media. Everything we do is referral based. I don't do any outside reach of advertising. And I said, well, if we set up some social media accounts, your child posts some things on there, post some articles, make some posts, create some pictures, designs, a bunch of stuff for your social media channel. And let's say nobody comes. Who cares? We paid your child to do it. Your child learned what doing some work to earn money is like. There's a lot of benefits in this, not just the tax savings. And so that's where I want people to be creative. Think of ways that your child can be working in your business. I run a podcast, I run an accounting firm, and I run a training program. You better believe when my child turns the age that they can be doing something there, I will find something for them to do in that business, paying them a reasonable rate for the type of work that they're doing. But it's just a way to shift some after-tax spending into pre-tax spending. A lot of people that we work with, because their child now has earned income, if you hire them, a lot of the clients that we work with will take that money, that earned income money, and fund a Roth IRA. With an earned income, you can have a Roth IRA. The downfall of a Roth IRA is that you don't get a tax deduction going into it, but it grows tax-free. Well, if you're not paying any income taxes at the young age, you don't need a tax deduction going into it, and you can start a Roth account at that young age that's going to grow tax-free. So even if you're like, I don't want my kids paying for their own basketball camps, fine. Use this money in different ways. Use it to fund that school account. Find opportunities to not only save taxes, but to also benefit your child. Again, not only is this saving taxes, but it's also helping your child understand working for a living. It helps them understand the business. If you ever plan to send this business off with them, it helps them get an understanding for that. So this is, again, one of my favorite tax strategies. And again, how this works is you get a business deduction, and it's potentially tax-free income to the child if you pay it out of a sole proprietorship or single member LLC. There's also no Social Security, Medicare, unemployment, things like that have to be done. So again, with this family, we paid $5,200 to the 10-year-old, For the 14-year-old, we did 12,000. That produced tax savings of just under $3,800. Again, not to mention all the other great benefits that came from this. All right, the 14-day home rental rule. This is also called the Augusta rule. And really what this came from is if you heard of the Masters tournaments in Augusta, Georgia, and what happened was it's a week-long tournament. People would rent out their homes for 7 days, and they ended up having to pay rental income taxes on that money that they received because everyone was coming in. There was no place to stay. And the IRS came and looked at it and they said, that's not right. That's not a rental property. It's a short term, less than, a certain amount of days. So the IRS implemented this rule that if you rent your home for 14 days or less, it's not taxable income to you. Again, if you rent your home for 14 days or less, it's not taxable income to you. So we kind of took this idea and switched it. So instead of thinking about Super Bowls and the Masters tournament, golf tournaments, things like that, how could we rent out our home to our business, get a business deduction, and pay no income tax on that income? Now, you have to have a legitimate qualifying occasion. You have to have a reasonable rate that you're using to determine that. And you have to have, the necessary documents to help support and back that up. But for this client, we said, this is going to be great. We're going to have corporate meetings. We're going to have a corporate meeting once a month. So we rented out, once a month, a corporate meeting that we're having in their house. Again, this doesn't take anything away from the home office. That's completely separate. This would be kind of one-off events or occasions that were happening. So we said, let's rent out your home to your business for client and corporate meetings. Let's do one a month. We called around to other hotels and co-sharing spaces and got rates on like, what would a boardroom be for a day rental? And so we kind of utilized that information to document what is a reasonable rate. And we determined on $750. So we took 12 days, $750. We got a business deduction, and there was no tax on that income personally. What a beautiful way to shift money from a taxable standpoint to a non-taxable standpoint. Again, simply by renting out their home to their business for business events. And as long as it was 14 days or less, that income is not taxable to them as a taxpayer. So by implementing the 14-day home rental rule, they were just able to save just under $2,000 in taxes from that specific strategy. The next thing that we did with them is we implemented a capitalization policy. And basically what a capitalization policy is put into place is to just say that any spending under a certain dollar amount is going to be expensed immediately. In any spending over that dollar amount, we're going to capitalize and depreciate. And so the IRS has allowed this, what they call de minimis amount, which is $2,500. So if you do spending and you buy an asset or an item for the office, whatever it might be, and it's $2,500 or less, if we have a capitalization policy in place, we can expense that immediately. And if we buy something over $2,500, then we capitalize it and depreciate it. So for all clients, everyone in our tax minimization program, we say, just put a capitalization policy in place. It creates consistency. We know if it's under $2,500, expense immediately on the profit and loss. Over $2,500, capitalize and depreciate it. Very easy peasy. This number used to be $500. So you go out and buy an iPhone for $1,000. Now you're having to capitalize it and depreciate it. You're going to have to put that on your tax return as an asset that's available there. Sure, you get a deduction. There's nothing wrong with capitalizing and depreciating. I don't want to say that, but I do want to say that it's a lot easier when you can expense it immediately. And that's why we put a capitalization policy in place with those numbers of $2,500. So we talked to this family, put a capitalization policy in place. They purchased a new computer, a new TV for their office, and a new desk and chair that they needed for the office, all utilizing this capitalization policy. Everything was under $2,500. So they simply expensed it immediately. And that provided tax savings of just over $800. Retirement plans. Now, when we talk about retirement plans, this is, a tax savings today. But when we talk about retirement plans, it's also pushing the can down the road because we're getting a tax savings today. But eventually, when we take money out of that retirement account, it is going to be taxable. So I love retirement plans. I think they're something everybody should have, not just for a savings tool, but also there is some tax planning with them. But I also like to caveat that by saying, this is not necessarily a forever tax savings. So when we talk to this family, again, remember this family is no employees. There was really two options that we have for retirement. We could do a solo 401k or a SEP IRA. Now this family, we talked to them, we said, how much money do you want to put away? $5,000 or less, don't do any business retirement plan. They, $5,000 to say $10,000 to $12,000, you might be looking at a SEP IRA. If you want to fully max out a retirement account, go as high as possible, that's when we're going to look at a solo 401k. And this family said, hey, we haven't done much retirement up to this point in our retirement planning up to this point in our life. We want to maximize this as much as possible. So they wanted to implement a solo 401k. They maxed out the employee contributions at $19,500, and they maxed out the employer contributions at $20,000. Now, the employer contributions is limited to 25% of their salary. And if you remember, we determined their reasonable salary as an S Corp owner was $80,000. The max employer contributions we can do is 25% of that, which is where that $20,000 number comes from. So with this family, we decided to implement a solo 401k, contribute $39,500 into it. There also is a Roth option that's oftentimes available on the employee side, if that's something that interests you. But by implementing that, we were able to save almost $8,700 in taxes this year. Again, think of tax or retirement plans as a deferral. You get a tax savings today, but we have to pay tax on it down the road. Well, if we look at hiring our kids, or we look at the Augusta rule, that's a tax deduction today, and there is no income on that. So just something to think about when we're looking at, deciding what strategies we want to implement, what we want to look at. All right, now let's go talk about some health strategies that we talked about with them. We implemented a few health strategies, just some main ones. Basically, we took the self-employed health insurance deduction. They were paying for insurance for their entire family. So we took a self-employed health insurance deduction. That was $1,000 a month, so $12,000 a year. Now, with an S corporation, we had to set up that self-employed health insurance. In order to take that deduction, we had to set it up correctly. Basically, we had to add it to our W-2 payroll, which is a good thing because it helps in the W-2 payroll, reasonable salary side. We had to add it to our payroll, run it through the business, and then we got the deduction on the personal side. So we made sure that they were doing that properly, had that set up correctly. We also recommend them to maximize a health savings account. And this is a key thing that I'd say, even if you're not a business owner, health savings account is something that everybody should be utilizing, because it's one of the only tools where you get a deduction going in, you get tax-free withdrawals, and all of your growth inside it also grows tax-free. So you get a deduction going in, grows tax-free, withdrawals are tax-free, assuming you use them for qualified medical expenses. So we highly recommend people utilizing a health savings account. If you qualify, now you have to have a high deductible plan, some other things, but if you qualify, utilize a health savings account. A lot of people come to me and they say, Mike, well, I'm healthy. Why would I utilize a health savings account? The only way to get that tax-free withdrawals is if you're utilizing it for qualified medical expenses. And I say, well, you might be healthy today, but think of this almost as like another retirement account. At some point in your lifetime, you're going to have medical costs. And instead of using other dollars to pay for those medical costs, why not have this health savings account that you've been putting money into, that's been growing even more? And now you're, instead of utilizing retirement funds or other funds that you have, you're utilizing tax-free money to pay that. All that growth you had is tax-free. So that's why, anyone that says I'm young or I'm there's no point in me doing HSA, I just say, think about it a little bit differently. At some point, you're going to need those funds. Think of it almost like another retirement account. It's going to be your retirement account for medical costs. The other thing, if they had high medical costs, they could have implemented a medical expense reimbursement plan to get a business deduction on medical expenses that they had. So basically, high medical costs, they can actually get a business deduction for it. That was a little bit more complex, and they didn't really have any high medical costs. Usually we say $5,000 a year outside of insurance is when this makes sense. Didn't really qualify them, so we didn't implement that plan for them, but it was an option out there for those that may have had it. So by doing the self-employed health insurance deduction and maximizing an HSA, they were able to save $4,200 in taxes. The next thing we did was then we talked about about some year-end tax strategies. And so we implemented some various year-end tax strategies. And basically, this is mainly for cash basis tax filers, but we prepaid some rent for January and February. So we got to the end of the year and we said, hey, we got some good income coming through here. Is there anything that we can prepay now here at the end of the year to get a deduction in this year because they're a cash basis taxpayer. So they prepaid the rent for January and February for their business, which is $1,000 a month. That's $2,000. And they also delayed some receiving of money. They had a large client that they've known forever, always pays on time, super reliable. And they said, hey, would you be able to wait till like January 1st to deposit our most recent, or to pay us for our most recent invoice? And they said, yeah, that's no problem. They weren't worried about not getting paid from this client. So they moved $7,000 from that client from December into the next year. And so these year-end tax strategies, again, are not necessarily something that it's going to affect you next year. So it's kind of like that snowball. If you get the deduction today, this year, you're not going to get it next year. Or if you don't get income this year, you're going to get it next year. So it's just kind of moving in between periods. But this is a lot of times some things that people do at the end of the year to try to rack that up. Again, I would never advise someone, don't go buy something you don't need. Don't do anything like that. But if you can take spending that you know you're going to do in the future and just kind of speed it up a little bit or slow down some receivables, that's a totally viable option to help out for this year at least. So those few changes that we did, again, prepaying rent by $2,000, having one of their biggest clients hold off on making their payment till the next year of $7,000. That saved just under $2,000 for this family. Now, again, what I want to talk about here is this idea of after tax versus pre-tax. I want to remind you about that. And so one thing that we did with this client is we went through their personal credit card statement to see if there was any expenses that were business related, but just missed. They simply were like, oh yeah, that was a business expense, or I did meet and we did talk business, but I paid for it with my personal card. I encourage you to think about that, because again, if we can take after-tax spending and move it to pre-tax spending, we're going to get a deduction for it. So we sat down with them. We said, let's go through your credit card line by line. You know, you had dinner here, you went to Office Max for this. Was there anything personal in there? Or, you know, you went to Target and you bought a bunch of things and you also got some shelves for your home office. This is actually something I just did. My wife bought me some shelves for the home office on our personal card. And I'm like, hey, that's a business expense. This is my home office. And so I had to get the receipt, and now we're going to do that, use the accountable plan to reimburse that. But it's things like that just kind of slip through the cracks. Those types of things happen. So we went with this family, we found $2,400 in items that we could classify as a business expense, utilize the accountable plan to reimburse them for them. And that saved them just over $500 in taxes. This process to do that took them maybe an hour to save $500 taxes. I think that's a pretty good ROI on that. Finally, what we did and talked with them about is bookkeeping. When we first talked to them, they were kind of utilizing Excel documents. They were waiting until the end of the year to do things. And we said, no. Let's clean things up. We want to make sure that everything is running like a well-oiled machine. So we got control of their bookkeeping. We set up a cloud-based bookkeeping system for them. We utilized a software called Zero for them. We connected bank feeds to that. And so basically they connected their bank feeds. All of their transactions come into the accounting software, and then they can code those transactions monthly to say, here's Office Max, that was for office expenses. Here comes Starbucks, that was for a business meeting. We're going to put that under meals or something like that. We got them on a cadence where they're doing that every month, continuously going in, coding all those transactions. Then we were able to use financials to analyze how was the business doing and how were various marketing efforts that they put in panning out. They did some marketing efforts in February. What did sales look like in March and April and May? Did it increase? Did it decrease? Did that marketing thing do anything? It helps. We utilize those financials to help them in their business. We also did a bunch of cost cutting. When we were going through this, we had to do some back bookkeeping for them. And when we first did all the back bookkeeping, we brought it up and said, okay, here's everything. And they said, wow, that software piece looks expensive. And so we said, well, let's dive into it. What's in there? There was a couple software pieces that they were spending, $30 a month, $60 a month on, that they were never using. But it was a monthly recurring charge that they were never utilizing. This is something that, having this bookkeeping done correctly, they took the time to look into that. Now you might say $50 a month is nothing, but over the course of 1 year, 2 year, 3 year, 5 years, that $50 starts to add up. and provide some savings that can be spent elsewhere in their business. But they would have never realized it because $50 leaving their credit card is just like, whatever, that's just new credit card balance. But when they start to actually drill down into it and say, where is this spending been going? It was like an aha moment for them. They were able to find some cost cutting opportunities for them. So again, we set up a cloud-based bookkeeping software, connected our bank feeds, our credit cards, all those transactions rolled through there. We got them on a regular cadence. Say, okay, every month we need to go in, we need to start coding what all these transactions are related to. And then let's start to analyze your financials. Let's look for cost-cutting opportunities. Let's see how your performance has been based on this items that we're doing. We did all of that on a monthly basis. And this just led to reduced stress because he knew how the business was performing on a regular basis. It made tax season so much easier because he was able to just take his financials. Everything was already done, send it over instead of trying to rush through everything, probably miss a bunch of things when tax season come. So it made that tax season much more painless. And he was able to sleep better at night because he knew things were set up correctly. Everything was going good. Even if they were having a bad time or a bad month, he could analyze it and say, okay, what are some cost cuttings we can do for this month? So bookkeeping is a key part, not to mention that by having clean bookkeeping, he now knows roughly or has a good idea of where his income is going to be and what tax strategies do we want to or do we need to implement to make sure we're paying the least amount of taxes legally possible. So that's a key thing, as I say, start to do your bookkeeping now. If you're sloppy, don't wait till the year's over to start to do the bookkeeping. So we say the stress savings from that was endless. So I want to wrap up. We have a few more things we want to go through, but I just want to say this is just getting started with the tax savings opportunities. And it seems like this family that we've been working with, they implement something new after each training in the tax minimization program. So they have still not taken advantage of every option. They also didn't maximize every opportunity that we talked about. You'll see some of those numbers. They were very conservative with some of those tax plannings. So they didn't implement every strategy that was available, and they haven't maximized every strategy that's available. This is really what we just call just starting to scratch the surface, but yet they still saved thousands in taxes. And they revisit all these strategies. And we talk about tax plan, it's something we need to revisit continuously. It's not set it up today, forget about it for 5 years. No, we want to continuously revisit. How have things changed? How have things changed in the business, personal life, whatever it might be? If they start to add employees in the business, there's even more planning opportunities and doors that open up there. If income spikes, let's say they get into the $300,000 or $400,000 range, that's going to open up the door for more advanced planning. So we're going above our core strategies. And if they were to sell the business or some other highly appreciated asset, that would open up the door to other advanced tax strategies. So what we talked about today is really just starting to scratch the surface about all the tax planning opportunities that's available. And I hope that's the takeaway of saying, look at all the strategies we talked about. Look at all the strategies that we ran through today. That's just scratching the surface. But all of these strategies, regardless of your size or where you're at in your business, could be implemented. So let's go through their tax savings. We implemented an S Corp for them. Again, help minimize the self-employment tax hit. That was $10,000, just under $11,000 in tax savings. We used an accountable plan to make sure that they were taking advantage of the home office. We use an accountable plan to reimburse themselves for business use of their personal vehicle, their cell phone, various other costs that were ran on the business account. They're on their personal account for that. We talked about meals. We said, let's find ways that we can be aggressive. Can we find a business purpose? Can we take after-tax dollars and move them to pre-tax dollars in meals that you're doing every day? We talked about travel. How can we combine the travel that we're doing around business items, attending a conference, visiting a client, visiting a vendor? That provided tax savings for them. We hired their kids in their business. Again, this is one of my favorite ones. Provided great tax savings for them, not just today, but that's going to be every year after year. But they also got some non-tangible, non-tax saving benefits out of hiring their kids. We talked about the 14-day home rental rule, the Augusta rule, where we rented out their business to their home for a monthly meeting. We talked about, we implemented a capitalization policy, and we bought some new refresh in their home office. We started a solo 401k. Again, SEP IRA is an option for them as well. We started a solo 401k for them. We started to put money away towards that. We utilized some health deductions, specifically the health savings account. And then we also worked on the self-employed health insurance, making sure that they had that set up correctly, especially being an S corporation. We did some year-end planning, some year-end adjustments for them to save taxes there. We looked through their credit card and said, okay, is there any tax savings that we can provide? Or is there any items that we paid for on our credit card that we can find a business purpose to? Kind of sifted through that, spent a little bit of time, found some more deductions there. Then we also had our bookkeeping. We got them set up on a bookkeeping system that they were doing consistently, accurately, and really utilizing that bookkeeping and bookkeeping system on a regular basis. We say stress savings were endless from that implementation. So after everything that we went through, again, rough numbers, they saved over $36,000 in taxes. By implementing everything that we talked about today, again, this is just scratching the surface. This is just starting to get into some of the things. They were not completely aggressive on everything, but they saved that much in taxes. This is available to you regardless of where you're at in your business. Now, this number is going to change, can go up, can go lower, whatever it might be for every individual situation. But this type of real life-changing tax savings is possible. So with that, I have some questions for you. What tax strategies are everyone listening here? Put them in the Q&A, put in the chat. What tax strategies are you currently utilizing? And how often are you revisiting your tax minimization strategy? And if those two questions are hard to answer for you, I want to say make 2022 the year you pay less in taxes and reduce your stress. It's clear the tax planning is not just for the rich. We just went through all of that. Whether you're making $10,000 a year or $1 million a year, there are strategies that are available to you. And tax planning is something that we should constantly be revisiting and adding to. This is not a set it and forget it activity. When we meet with this family the year later, we added more strategies to it. Maybe took some out. We did all sorts of things. It's a constant planning. And what I always say is always be learning, always be implementing. And if you do that, you're always going to be saving taxes. Put that tax planning hat on. Take that mind shift change. So I want to talk about something that we have. It's called our tax minimization program. And I think if you're interested, if this is something like I wanted to implement these strategies, I want to learn about the strategies, our tax minimization program is something that you should be looking into. Basically, our tax minimization program is a library of tax strategies, implementation guides, videos, downloads on all of these tax strategies and so much more. We have over 12 modules of content where we go through the strategy, show you how to implement it, explain it to you. We also have a stress-free bookkeeping training program. And that bookkeeping training program is where we teach you how to do your own bookkeeping, what's important out of that. And one of my favorite bonuses that we have in this is that you have unlimited access to me. You have unlimited access to our team. You have unlimited access to our team for those general tax and accounting questions. So I always say, think of it like having an accountant in your back pocket. You're about to go purchase something. And you're wondering, how do I hire my kids? Or is this a tax deduction? Shoot us an email. We'll respond to you. You also have access to a private Facebook group. You have access to a private webinar. We do monthly webinars. We deep dive into tax strategies. Those are only available to tax minimization program members. And you also have access to our network of referral partners. Whatever you might be looking for in your business, there is likely someone that we can direct you to or get you in front of. I had a tax minimization program member hit me up the other day and said, hey, Mike, I'm looking to take my family to the Kentucky Derby, but I'm looking to take my family to the Kentucky Derby and I want to rent the jet. I want to do this and it's just an experience for them. Do you have any? I'm like, as a matter of fact, I do have someone I can get you in front of. So obviously that's kind of a rare occasion, but I say that to say that our range of people that we have connected with for our members is wide. And that's where you have access to that. So you can join now. You can go to taxsavingspodcast.com/tax. That's taxsavingspodcast.com/tax. I want to take you through this idea of the roadmap to tax minimization. Or what does that journey look like from paying too much tax to paying the least amount in taxes as legally possible? And so our starting point for that is what we call step one. It's understanding taxes and tax planning. Now, we're not expecting you to be an expert tax planner or an expert in taxes, but this idea of understanding tax and tax planning means we want to set a foundation. We want you to understand how you're being taxed. We want you to understand what tax planning is, because that's going to build your foundation. That's going to build into what strategies make sense. You just need that core understanding. This is something we do in our tax minimization program. Once you've made it through that step, we start to build the foundation of your business. We want to have solid ground that we're building everything off of. So we build the foundation to your business. This might be an entity structure. This might be a capitalization policy, an accountable plan. We're building that foundation of things that we need to set in place that make sure your business can run smooth and be ready for tax savings. Then we start to implement what we call our core tax strategies. These are much of what we talked about today and so much more. Utilizing an S Corp, hiring our kids, using the 14-day home rental. So we want to make sure we're learning about all those and then implementing them once we have that foundation built. From there, we're expanding, we're growing, we're developing that tax planning. We're always revisiting, we're always looking at it again. We're finding ways that we can save more. Sometimes we might lose a tax strategy for whatever reason. What can we fill it in with? Where can we increase or adjust our tax planning strategies? And once we get to a point where our income makes sense, so we're looking to sell our business or some other highly appreciated asset, then we look at advanced tax strategies and advanced tax planning. These are strategies for high income earners or those that are selling something for a large gain. And so that's kind of that journey to tax minimization that we talk about. Understand taxes and tax planning, build the foundation for your business, that solid ground that everything else is going to come off of, implement core tax strategies, expand, revisit, grow, develop those core strategies and everything else we're developing. And then once our business gets to a point where we become a high net worth or we're selling a highly appreciated asset, again, this is typically in the $300,000, $400,000 or more range, then we're going to look at advanced tax planning. And we might jump between stages in between there. This is everything that we go through within our tax minimization program. We're taking and going with you along that journey to making sure you go from paying too much in tax to paying the least amount in taxes legally possible. So I recommend that you sign up today. Again, go to taxsavingspodcast.com/tax. And if you sign up within the next 4 days, you're going to receive a recording of our 2022 Small Business Tax Savings Summit. This was a 2-day, 12-hour event that we held back at the beginning of June. It was a $500 value for this. We have recordings of everything. We did, again, 2 days, 12 hours of content going through strategies, implementing everything, what you need to know about it. We have recordings of all of that. If you sign up within the next 4 days, we're going to include that in your membership to the tax minimization program, the recordings from that 2022 Small Business Tax Savings Summit. Again, you can go to taxsavingspodcast.com/tax and fill out the information in there. So next steps: 1, join our tax minimization program. 2, if you're not quite ready for that part, start listening to our podcast if you're not already. Podcast, we do weekly episodes on tax tips, accounting tips. We also pair that with a blog post. So just type in Small Business Tax Savings Podcast in any podcasting platform. You'll find that there. And also join our free Facebook group. Search in Facebook, Small Business Tax Secrets, answer a few questions, and join there. That's what I have for today. I want to thank you for coming along on this journey, this roadmap to tax savings. And I hope to see you within our tax minimization program, as a listener on our podcast, within our free Facebook group, wherever it might be. I hope to see you again soon. All right. So now I'm going to go through some questions. And calling from Texas, great. Yes, you can hear me. Someone calling from Israel, Virginia, San Francisco. A lot of people calling. The podcast is awesome. It has everything on there. Will recording be available afterwards in Tax Minimization Library? Terry, yes, recording will be available. How often should owner draws be taken? Can it be taken at the end of the year? You can take owner draws whenever you want. Simply transferring money from your business account to your personal account. Those can happen at any point in time. This recording going to be available to view later? Yes, it will. There will be an email that goes out for everyone that signed up for this that you'll be able to request a recording of this. We have a question from Desmond. It says, I'm a single member LLC and my wife helps me with the business. I usually take an owner's draw to pay bills and pay myself. Would it be better to pay my wife as an employee and take federal taxes out for her? Desmond, it really depends. Typically, we say, if you're the business owner, the only time we'd want to hire a spouse in that business is if we're looking to max out a retirement account, or there's some other health tax strategies that we might utilize if you have high health costs. Other than that, we say typically, we don't want to pay unnecessary self-employment taxes. So Desmond, I would say, depending on your income, you might want to look at an S corporation. If you go to taxsavingspodcast.com/S corp, I believe it is, we have a ton of information in the S corporations, but that would be something I look at. Traditionally, no point in hiring a spouse unless you're looking to maximize retirement or you have high medical costs and we're utilizing some type of health tax strategy around it. What happens to child tax credit when you hire your children? Nothing, still available. What type of retirement accounts can you open as an S corporation and what is the max? So with an S corporation, and this is really any business, but you have a SEP IRA, a solo 401k, then you can get into a traditional IRA or a traditional 401k or a QACA safe harbor 401k or a simple IRA. If you have no employees, you're going to look at a SEP IRA or a solo 401k. SEP IRA is limited in an S corp to 25% of your income total. Solo 401k, you can do $19,500 plus the employer, which is your S corp, can match or it can do 25%. If you have employees, you're going to look at a simple IRA or some type of 401k, QACA safe harbor, something like that. Is a single member on S corp, as a single member on S corp, some insurance doesn't allow just the owner to own a health insurance. How can you set up health insurance? If you're just the owner, if you're an S corp owner, you can run the business you can run the insurance through the business, even if it's just under your personal name. It does not need to be in the business's name. In respect to receipts, can the credit card statement be used? You would just need to make sure you have documentation of who you were with, what was ordered, everything like that. We always say on the receipt, just write directly on the receipt, who you were with, what was the purpose of that meeting, what was the business purpose, and as much detail as you can write on a receipt. Take a picture of it, put it into a digital file format, and save it a labor. That way you have it on file should you need it, but you don't have to keep a box in the corner of your office or anything like that. What happens if plenty of the expenses were paid with a personal account? If you had business items that were paid for personally, you're going to want to use an accountable plan to reimburse yourself for those items. Make sure you're going through and recording that. We have a question here. What is included in gross receipts and sales? That's going to be your revenue, all of the income from the business. So with a business, you have gross receipts, sales, everything else, revenue, services. Then you have all your expenses, and then whatever's left over is your profit. What is the price of the program? Our tax minimization program is $99 a month. For the health insurance deduction, the health insurance needs to be deducted from payroll. So if you're an S corporation, there's a little bit of hoops that you have to jump through for the S corporation health insurance deduction. First off, pay for it throughout the business. Second, add it to your W-2 payroll. If you contact your payroll provider, they'll know exactly how to do S corp owner add backs to their payroll. And then third, you'll take the deduction on your personal tax return. Same thing, you still get a deduction for it no matter what. There's just a few steps that they make you jump through in order to be able to take it. Are you only deducting the health insurance for yourself and not family? No, for the self-employed health insurance deduction, it can be for the family. How do you determine when it's time to move from a simple IRA to a 401k less than 10 employees? Ryan, that's going to be a specific situation to you. Personally, it's just going to depend on how much, when we look at a retirement plan for a business, there's two questions that we always ask. Is this to benefit the owner? Are we implementing a retirement plan to benefit the owner so they can maximize retirement? Or are we utilizing it to help get and retain highly qualified staff? Usually it's some combination of the two. And then it comes down to how much you want both as the owner. With a simple IRA, you're restricted a little bit. There's not much flexibility with it. But it's very simple, easy to understand. With a 401k, there's a lot more customization you can do. You can actually, if you can put more away into retirement. So if you're looking to really, as an owner, maximize retirement, you're probably going to want to look into some 401k. Oftentimes we're looking at a safe harbor, QACA 401k. Can I begin to lease or buy a car as a write-off mid-year? Absolutely. If you have a business purpose for that vehicle, you can buy that whenever you want throughout the year. You know, if you're leasing it, you have lease expenses going through the business. If you're buying it, we're looking at probably bonus depreciation, or, you know, depending on what type of vehicle it is, something else here in 2022. But absolutely, you can utilize that. Now, if it's going to be personal and business mix, traditionally I say pay for that personally and then utilize an accountable plan to have your business reimburse you for the business use of that automobile. But if it's 100% business use, and this goes with everything, if it's 100% business purpose, 100% business use, run that puppy through your business. Can you get an HSA without medical insurance or low deductible health insurance? No, in order to have an HSA, you have to have a high deductible health insurance plan. Do you suggest S Corp for businesses that make less than $50,000? Is it $50,000 profit or annual income? So this is just a rough number that we utilize. We usually say $50,000 in profit or more is when an S Corp makes sense. If you're under $50,000 in profit, it's not necessarily going to hurt you. It's just with an S Corporation, now we have to run payroll. That has a cost to it. We also have a business tax return, which is going to cost a little bit more to prep than just a normal Schedule C or something like that. So there's some added costs when we look at doing an S corporation. And so we say, you know, some of those costs will eat up your tax savings at a lower dollar amount. So we typically say once $50,000 or more is hit, that's where the S corporation is going to make sense. Doesn't necessarily hurt you underneath that. What type of health insurances can be deducted? Any kind of normal health insurance, you know, whatever qualifies for the IRS is health insurance. If it's a Medi-Share plan or some of those Christian share plans, those are not considered health insurance. That would not be a self-employed health insurance deduction. Had a few people in here just saying thanks for everything, of course. We have someone here that says, how do you set up a family management company to take advantage of hiring your kids as an S corporation? So you can hire your kids as an S corporation without a family management company. They're still going to pay no income taxes on the first $12,950 because it's under the standard deduction. It's just if you pay them if you pay them under the actual S corporation, you're going to have to withhold Social Security, Medicare, and unemployment because you're not hiring your own children anymore. Your business, which is a separate entity, is hiring your children. So if you pay them as an S out of your S corporation, totally fine. It's just you're going to get hit with self-employment taxes, Social Security, Medicare, unemployment, which is roughly 15%. Again, these are all business deductions. So still a beautiful thing, beautiful workaround. Other people say, well, I want to avoid that FICA taxes. So I set up a family management company. This is just going to be a sole proprietorship that you set up and then you hire your kids through that. So, you know, let's say you're providing your kids are providing marketing services. You might set up a sole proprietorship family management company that does marketing services for your S corporation. So your S corporation pays family management company for marketing services. Family management company pays your children for the marketing and work that they're doing with inside of that entity. S corp question again. Currently LLC, just hired 2 part-time employees. Can I still change to S corp or remain LLC? Absolutely. Yeah, absolutely. You can move to an S corporation. In order to have an S corporation, you need to have an LLC. And so you're going to still remain an LLC. You're just electing for that LLC that you have to be taxed as an S corporation. So you're not getting rid of the S corporation. You're just electing for that LLC that you have to be taxed as an S corporation. Which brings up a key point. If you don't have an LLC set up, you can't be an S corporation. So when we talk about building that foundation, we talked about the roadmap. Let me bring this back up. We talk about this journey to tax minimization. This building the foundation of your business is a key part. This is what we're going to say, you know, if you plan to make this something, you might want to have that LLC set up because S corp might not make sense today for you. But what happens if you get a big contract and now your income jumps and now You don't have an entity set up. So just keep that in mind, that if you're just a sole proprietorship, no LLC set up, you actually cannot be an S corporation. So if you have a huge year, and also let's say you have, you bring in $150,000 today from a big contract you signed under a sole proprietorship, there's no S corp that we can do with that. Now, if we start an LLC tomorrow, then we can do an S corp from tomorrow forward, but with no LLC, there's no S corp options. If my spouse registers for health insurance, can you open HSA from the company or from W-2 you take? As long as you have high deductible health insurance, you can have an HSA. HSA is not necessarily something that's going to be done on the business side. That's just a deduction that you're going to pay for personally and take personally. So it's more of a general planning, not just a small business owner only type of planning opportunity. We have someone here that says, do you work with LLC, S Corp, W-2 travel nurses with also working at travel agency, working as a W-2? If the question is, would that be a client that we'd work with or that would be good for our tax minimization program? The answer would be, yeah, absolutely. Anybody that has a business has a business or is high net worth is going to really be able to take advantage of our tax minimization program. If you're just a W-2 employee, not in a high net worth area, tax minimization program is not going to do too much for you, because most of the tax strategies that we're talking about is through the business. How are we utilizing our business? And it's kind of funny. Oftentimes we say the first tax strategy that anybody should do is start a business or buy a rental property, because that opens up the door for so many of these after-tax spending that you can move into pre-tax spending and take advantage of. Someone said, does HSA basic insurance cover major hospitalization? I don't think that's a good context for this. Next question is, I currently do the bookkeeping and taxes for my business, but I'd like more training to make sure I'm doing things right. I'm not an expert, but I feel like I got a pretty good handle on it. Do you recommend getting a bookkeeper CPA to advise me? Honestly, I would say if you feel like you have a good handle on it, check out our tax minimization program. Our tax minimization program, we teach bookkeeping, we teach all these tax strategies, what you need to do, what you need to be implemented in. And if you're like, hey, I need that extra step, then reach out to us. We have a full service accounting firm on the back end that we work exclusively with small businesses and high net worth individuals, that we do, we take this kind of do it yourself or done with you, and we do it for you. So whatever the answer, try one. If you're like, no, I don't want to do this anymore, I don't want to do the bookkeeping, I don't want to do tax prep, I just want someone to help for me, we have an accounting firm that can help with that as well. Okay. Any other questions? I know we're over time, but we still have people hanging out here, so I figured I would ask as much as, or answer as many questions as we have. If you're interested, again, is check out our tax minimization program, taxsavingspodcast.com/tax. Sarah, is your tax minimization program a business expense? Absolutely. Yes. Great point. Any other questions? Leave it open for a couple minutes here, and then we'll be good. Again, some of the next steps here. Tax minimization program within the next 4 days. taxsavingspodcast.com/tax. If you are not already a listener to the podcast, definitely check that out. We do weekly episodes. We do blog posts that go along with it. Go to taxsavingspodcast.com, find information there, or go into any podcasting platform. Just type in Small Business Tax Savings Podcast. We'll talk about there, and also join us on our free Facebook group. Someone says, you might have answered this. What is a retirement account you can open as an S corporation? Pretty much any of them. SEP IRA, solo 401k, simple IRA, any type of 401k, traditional QACA, safe harbor. All those are all retirement accounts. If you're just looking to put away $5,000 or less, just open up a traditional IRA. Don't worry about running that through the business. If you're looking to max out a retirement plan, then you're just going to start looking at the SEP, the solo, the simple, the regular 401k, and all those. All right, we'll leave things open here for 15 seconds if anything else comes through. Otherwise, guys, thanks for coming. Thanks for showing up, waiting to the end. So we had a question pop up here. Do you recommend QuickBooks for bookkeeping? So we use a software called Xero in our firm, and we also use QuickBooks as well, but we prefer Xero. I always say QuickBooks and Xero is kind of like Apple versus Android. So many people, an Apple phone or an Android phone, they both are made for the certain type of person. They're both great products. They both do the same thing. It's just some people have a user preference. They prefer the user interface of one or the other. That's what I compare QuickBooks versus Xero. Both are made for the same type of business owners, have very good software, great programs. It's just some people prefer one over the other when it talks about a user interface. We prefer Xero, it's spelled Xero, but we also work with QuickBooks and know that QuickBooks is obviously the leader, at least at the standpoint in the US. Xero was a bookkeeping software. They're like the QuickBooks in Australia and New Zealand, and came to the US about 8 years ago. We were one of the early adapters of them, implementing them in our business. Okay, that looks like it. Thanks again, guys. I appreciate you guys coming out. Hope to see you in the tax minimization program. Hope to see you as a listener on the podcast or wherever you might find us. Really excited to get to know everybody here. So thanks, guys. Have a great rest of your week.